Take a deep breath. Feel that pulse in your wrist? In 2026, that rhythm isn't just your life force, it's your interest rate. Imagine waking up, checking your banking app, and seeing your mortgage rate just ticked up by 0.5%. Why? Because you had a stressful week, your sleep was trash, and your smartwatch told your bank everything. It's not a sci-fi movie. It's the new reality of the $15 trillion global insurance and lending market. And here's the deal. The traditional credit score is dying, and your biology is taking its place. For decades, we relied on the FICO score. It was about your bank balance, your payment history, and how much debt you carried. But in this volatile 2026 economy, lenders have realized something. FICO is slow. It's a rear-view mirror. They want a windshield. They want to know what you're doing now. And the wearable medical device market has exploded to meet that demand, hitting $117.4 billion. That's a 145% jump in just 3 years. We're not just buying these things to count steps anymore. We're wearing them because the financial system is demanding a digital tether to our vital signs. Look at John Hancock. They're one of the oldest names in the game, but as of now, they've completely stopped selling traditional life insurance. They moved 100% to interactive biomonitoring models. You want the policy? You wear the tech. You want the discount? You share the data. It sounds like a fair trade on the surface, right? A 25% discount just for staying healthy? Well, not so fast. Because when the world's largest financial institutions start caring about your cortisol levels, the math of risk changes forever. If your bank knows your heart rate better than your doctor does, what exactly are they calculating while you sleep? Let that sink in. Okay, let's talk about the real problem, the Bio API. This is the technical bridge that's quietly being built between your health apps and your bank's underwriting department. We're talking about Apple Health Kit and Google Fit data being sucked directly into banking algorithms, and here's where it gets wild. AI isn't just looking at whether you ran a 5K, it's analyzing heart rate variability, or HRV. Why? Because high-frequency data shows a direct correlation between low HRV, poor sleep, and something called impulse control failure. In plain English, if you didn't sleep well and your heart is stressed, you're statistically more likely to make a bad financial decision or default on a loan. Ping An, the Chinese insurance giant, is already using AI to analyze over 128 biological dimensions in real time. They aren't just checking if you're alive, they're checking how you're living. When medical inflation is sitting at a staggering 10.3%, the insurance industry can't afford to wait for you to get sick. They need to hedge their risk in real time. Your cortisol levels, that stress hormone, is now a real-time risk hedge for a multi-trillion-dollar industry. It's the ultimate granular data play. They're moving from static mortality, where they check in on you once a year, to live biofeedback, where they ping you 25 times a month.
I know, it sounds like they're just trying to help you stay healthy. And sure, for the 52% of high-risk members who've seen their blood pressure normalize through these wellness rewards, it feels like a win. But think about the leverage here. This isn't just about wellness, it's about pricing the one thing you can't fake, your biology.
When the algorithm sees a spike in your resting heart rate, it doesn't see a human who's tired. It sees a data point that suggests your biological credit just took a hit. This is the part nobody's talking about. We're turning the human body into a liquid asset that can be devalued by a bad night's sleep.
So who's actually holding the keys to this data vault? It's not just your local bank. There's a whole layer of bio-fintech middleware companies like Human API and massive reinsurers like Swiss Re that are capturing what they call truth data. These are the middlemen of the soul. They're building the infrastructure that allows a mortgage lender in New York to price a loan based on the biometric data of a gig worker in Seattle.
They're bypassing traditional brokers and going straight for the raw biological source. And honestly, this is the most interesting part of the whole story. We're letting them do it. The latest data shows that 69% of US adults are now willing to trade their health privacy for a discount. But let's be real. Is it actually a choice? When the cost of living crisis is squeezing every penny out of your paycheck, a 25% discount on your insurance or a lower APR on your car loan isn't a perk. It's a survival strategy. The financial system is using our economic desperation as leverage to buy the rights to our DNA and our heartbeats. We think we're getting a deal, but we're actually selling the last piece of privacy we have left. Think about that next time you see your grocery bill or your rent statement. If the only way to afford your life is to strap on a tracker and let a reinsurer monitor your sleep, then privacy has officially become a luxury good. Those who can afford to keep their data private will pay a privacy premium, while everyone else is forced into the biological ledger. We're creating a world where your financial alpha, your edge, is literally your health. But what happens when that health starts to fade? That's where the story takes a much darker turn. Now, this is the part I find wild. This isn't actually a new idea. It's just an old predatory ghost in a new digital suit. If we look back to the 19th century, there was something called a tontine. It was basically a death lottery. A group of people would pool their money, and the last ones standing would get the payout. In the 1800s, there was a famous case called the 30 Young Geneva Girls, where insurers literally bet on which healthy girls would live the longest to maximize their returns. It was so predatory that the 1905 Armstrong investigation eventually stepped in and banned these structures. We decided as a society that betting on people's lives was a bridge too far. But look at where we are now. The 2026 biocredit system has an 88% similarity to those old-school physical exams and moral character checks. The difference? Back then, there was a human buffer. A doctor or an agent had to look you in the eye. Today, that buffer is gone. It's been replaced by automated exclusion. The algorithm doesn't care about your moral character. It cares about the 128 dimensions of data it's pulling from your wrist. We're returning to the era of betting on lives, but this time, the house has 24/7 digital surveillance and AI that can predict your death with 98% accuracy. History shows we once fought to keep our bodies off the balance sheet. We realized that once you turn a human being into a set of risk metrics, you lose the human part of the equation. But in 2026, we've forgotten that lesson. We've traded the 1905 human buffer for a 2026 automated exclusion. And if the world's largest pension funds and reinsurers are moving their money into these bio-integrated models, what does that tell you? It tells you that they've found a way to win the death lottery again. The question is, are you a player or are you just the collateral? Let's zoom out for a second and look at the map of where this is going. We are witnessing the rise of the biological underclass. If you have a chronic illness, if you work 3 jobs and can't get 8 hours of sleep, or if you simply refuse to wear the tracker, you're being priced out of the modern economy. This is biological redlining. It's the same old discrimination, just with better data. The EU Commissioner, Vera Jourova, has already issued a warning, using biometric surveillance for credit scoring risks, creating a new social caste system. And she's right. When your mortgage depends on your heartbeat, social mobility stops being about hard work and starts being about genetics. We're heading toward a world of pulse-linked APRs. Your interest rate will fluctuate weekly based on your bioscore. A good week at the gym, your rate drops. A funeral in the family and a spike in stress, your rate climbs. It sounds efficient, but it's actually the end of financial agency. You aren't a person anymore. You're a walking, breathing risk profile. The choice is no longer between being healthy and unhealthy. It's between being visible and being bankrupt. If you aren't on the grid, if your pulse isn't being uploaded to the cloud, you simply don't exist to the lenders of 2026. So here's the question I want to leave you with. In a world where your privacy isn't being stolen, but is being priced out of your reach, one heartbeat at a time, how much is your heart really worth to you? Because the banks have already done the math and they've decided it's worth exactly $15 trillion. This isn't just about insurance, it's about the fundamental restructuring of human value. Next time your watch pings you to stand up or take a breath, just remember, someone on a trading floor in Zurich is watching that notification too. And they're waiting to see if you'll comply.